You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Today, I thought we would talk about what happens if my life insurance policy becomes a MEC. And why did modified endowment contracts begin? Well, modified endowment contracts were introduced as a result of TAMRA, the Technical and Miscellaneous Revenue Act of 1988. The main reason for the creation of modified endowment contracts was to address what they considered to be the misuse of life insurance policies as tax shelters. Before modified endowment contracts were created, people could fund life insurance policies with super large premiums if they wanted to. And of course, that money would grow tax deferred and they could access it income tax free through loans and withdrawals, all the good stuff. So the government realized that people were purchasing these financial vehicles even if the policy's main purpose was not to provide life insurance protection, but instead to serve more like an investment vehicle. So, of course, the IRS then it swoops on in and says, I don't think so, and established rules that reclassified certain life insurance policies as modified endowment contracts if they failed the 7-pay test. Now, I'm sure you're wondering, what is the 7-pay test? The 7-pay test limits the amount of money that can be paid into the policy in its early years. So I'm going to read this explanation right off of an illustration and where they describe the MEC area. It says, a policy fails the 7-pay test if at any time during the first 7 years, the amount paid into the policy exceeds the sum of the 7-pay annual premiums. So there's policies out there that can be acquired 10-pay, 20-pay. That just means the policy is paid up after that amount of years, and you have a certain amount of death benefit, and the policy has no more premiums. So they're trying to say as if you were to pay up the policy in 7 years, which we would generally not do. Then it goes on to say, a material change in policy benefits or other terms may require retesting as if it were a newly issued policy. So that's why you have to be careful. You don't want to just assume because the illustration showed as a non-MEC on day one that it could never happen, that it's impossible to happen, because it could if it had to be retested for some reason. So if the policy fails this 7-pay test, it becomes a modified endowment contract. And withdrawals or loans of the gain of the policy, the gain inside the policy, are taxable. The changes that were made and the creation of the modified endowment contract were meant to ensure that the primary purpose of life insurance policies continued to be the protection, which has always been the purpose of a life insurance policy, rather than an investment with tax advantages. What the government was trying to prevent is a policy's cash value growing too much too soon, because then it looks more like an investment. However, that's exactly the purpose of the paid-up additions rider that we add on to these policies so that you have access to more cash sooner. The paid-up additions rider does help to grow cash quickly. So that's why you have to be careful with the rider. You need to be careful of building too much cash value too soon, of making too large of a paid-up additions rider with too small of a base premium, because that's what they're looking for when they're looking for a MEC. Now, prior to the creation of the MEC, Modified Endowment Contract, many affluent people and business owners were purchasing large single premium policies. So they were building into their policies the maximum amount of cash as soon as possible. They would have access to the majority of the premium that they just paid in year one. So they were really shoving it full of cash. So a single premium policy, which is totally still possible, and people still sometimes will purchase a single premium, is when you have a really small base premium and a really large paid-up additions premium. Now, there's different calculations and percentages as to what a life insurance company will allow as far as when you're shrinking down the base premium. There's different rules at different companies for how low they'll allow you to lower the base premium and how large of a paid up additions premium you can put on this policy. But it's squished down pretty well, the base premium. So you have access to all this cash, the majority, let's say 90% of your cash value or maybe more is available in the paid up additions. It's available in cash value to borrow against in year one. And then once that's going, it has, of course, the startup costs like any IBC style or structured whole life policy. You don't have access to every single dollar you paid in year one, but you do have access to a sizable majority of that cash. And then from there, it will start to grow very well, very efficiently, and it will provide a death benefit. And so I think there's still a purpose. There's a time when these policies are fitting for some people. It's still a place where you can grow cash. It will grow on a guaranteed basis. You'll have access to it. You'll have a death benefit. Of course, it's a MEC for sure, so it's going to be taxable when you borrow. Even when you take out loans on that policy, the gains will be taxable, and or if you withdraw, the gains will be taxable. But if you're comparing it to another type of taxable account, then maybe it still wins out and is the better way to go. So it's possible to do this, and it's sometimes a good idea or a good fit for the right person in the right situation. Okay, now let's talk about the downsides. The biggest downside to your contract becoming a MEC is the change in how policy loans and withdrawals are taxed. Because not only are withdrawals taxable, but like I just said, so are your loans. So once your policy has MEC'd, because sometimes we turn that word into a verb, the earnings within your policy are subject to income tax on any loans, withdrawals, or surrenders. Another downside to causing your contract to MEC or having it MEC accidentally is the potential of a 10% penalty when either withdrawing or borrowing funds from your policy or against your policy on the earnings. So if you're borrowing against the earnings of the policy and you're under 59.5, you will have a 10% penalty, just like you would pulling from your IRA if you're under 59.5. Another difference or downside would be FIFO versus LIFO. So when you're making withdrawals from your life insurance policy that has not become a MEC, then your withdrawals are taxed FIFO, first in, first out. This means that when you pull money from the policy, if it is your cost basis or lower than your cost basis, and your cost basis is what you paid into the contract. So let's say you paid into the contract $100,000. Anything you pull out up to $100,000 is not taxable because that's the money you put into the contract. And when you're making a withdrawal from a contract that is a non-MEC, up to the first $100,000 will not be taxed. So you don't have to worry about the tax. At least you don't have to worry about the tax up to $100,000. After that, it would be taxable if you withdraw the money. But if your policy changes from a life policy to a modified endowment contract because of overfunding, putting too much money into the contract, then your withdrawals will be taxed as LIFO, last in, first out. So this means that the earnings will be taxed first. So in the same example I just gave, if you had a cost basis, you had funded a policy with $100,000 over your lifetime, and let's just say the contract had $200,000 in it, and you want to take out $10,000. Well, that withdrawal will be taxed first. It will be taxed. You will not get it tax-free because you already had funded $100,000 into the contract. They're going to tax your earnings first when they pull out the money. That's the first thing to happen. And if you're under 59.5, you will also have to pay a penalty on that $10,000 that you're withdrawing. And even if you decide you have $200,000 in your account, $100,000 of it was money you funded into it, the money you paid into it, and you want to borrow $10,000, you will still have to pay tax and penalty if you're under 59.5 on that $10,000 loan. Not good. So one thing that remains the same, thankfully, is the income tax-free death benefit. Even if your policy becomes a modified endowment contract, the death benefit paid to your beneficiaries will still be income tax-free. So that's good news. And if your policy does end up becoming a MEC, it's still a good contract. Don't get totally broken up about it. Your policy's cash value will still be growing with a guaranteed crediting rate. It will still earn dividends. You'll still be able to borrow against the policy. So your whole value will still be earning for you even when you borrow against it. And that's part of the magic of the infinite banking concept. It can still be great. It's just not as great as if it had remained a non MEC so that you could avoid having to pay tax or possibly penalty when accessing your funds. These tax advantages are one of the great things about these policies and implementing the infinite banking concept, which is one reason or why I'm so careful when designing these policies, because I don't want it to mech on you 10 years, 20, 30, 40 years out from now. I want you to have a perfectly good policy that does not mech, stays intact, and works excellently for your whole life. I don't just want to say, oh, yeah, oh, here, we'll just put a whole bunch of cash in, we'll make it really great. We'll lower the base super low and you'll have access to a bunch of cash in the beginning. I don't want to just design it without the concern or the thought of wanting to build a super strong policy to protect against MEC because it is a big deal. You don't want to lose those tax advantages. And unfortunately, there are plenty of agents out there just trying to make their design look the best and have the most cash right away as soon as possible. And even though the illustration may say it's not a MEC, it's still at a higher risk because of the policy design. Because just because a policy may illustrate as a non MEC today doesn't mean it can't MEC in the future. So you for sure want a really strong, sturdy contract, not built with such a low base that you have a really high risk of mecking that contract. Of course, we've talked before about how there are term writers to add, and that all helps and everything. And I add those too all the time. But you don't want to build your policy with just so much internal term and barely any base, just so that you can have as much cash as possible in the beginning, because you definitely risk a MEC. And unfortunately, it's not possible for any agent anywhere to fully guarantee that a contract will never become a MEC. And as I've mentioned before, if it did, if it was built the best way possible, something happened, or you put too much money in on accident for some reason, and you caught it in time because the company will mail a letter. If you catch it in time, most companies, as far as I'm aware, will help you back out of that. We'll send the money back, we'll refund the additional funds that are in the contract to get you back out of the MEC status, and then you can stop overfunding it going forward. But it's just that you'd have to catch it. And most times it turns into a MEC and it goes right by your attention and you don't know what happened and then it's too late. So that is why policy design is so important. Having a knowledgeable IBC practitioner is so important. Having a higher base premium so your policy is more protected is so important because you will want to protect your contract against a future MEC as much as possible. But again, if it ends up happening, it doesn't mean your policy is trash. And another thing to keep in mind is if your policy does become a MEC and you're thinking that you should terminate that contract and roll the funds into a new whole life contract, well, that'll be a bad idea. If you transfer those funds to a new contract, you will transfer the MEC status as well. This actually almost happened to a client of mine just recently. He was a client who was transferred over to me when a colleague left the business. He had stopped paying on the contract and made it a paid up contract on purpose. So there was still a death benefit and the cash value was growing, but it's not like the client's account page just screamed, "This is a MEC." So I hadn't noticed it. The client contacts me saying he wants to start funding whole life again and wanted to transfer the funds that were in his current account to his new account once we got it opened. So I do all this for him. I got it all completed. He gets approved for a new life policy, and the company began moving the funds through a 1035. But then my new business team reached out and said, "Hey, your client needs to sign this form that acknowledges his new contract is a MEC." Huh? What? Excuse me? I don't think so. So we rewound everything. I asked them to send the funds back to the original contract, set that old contract back up, and that we would not be rolling those funds over, just to put them back where they were. And thankfully, they did it. They put the funds back, and we just started fresh. So you got to be careful. Make sure you're working with someone solid who knows what the heck they're doing to protect your policy as much as possible. On that note, if you feel that I would be a great advisor to partner with and you would like my help, feel free to reach out to me. You can reach me at Valerie@alphaomegawealth.com. I appreciate you listening to the podcast. You might want to share this episode with anyone who is learning alongside you to help them understand modified endowment contracts better. But I appreciate you listening. Thank you so much. And I hope you have a great week. Take care.